The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflation data hovers over a market perched at a record high. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Vonnie Quinn. We are counting you down to the closing bell here in the United States. So let's have a look at those markets. Risk off just a little bit, although I will say we are pretty much treading water before the CPI inflation data tomorrow. As you can see, the S&P 500 hovering around those records still, just down fractionally. Same with the NASDAQ 100. And we just got that idea that we're going to get another 90-day extension to the China tariff problem. So that should have taken a risk out of the market, at least for now. But we're just treading water, as I said. The two-year yield still at about 3.75 before that inflation data. So the repricing happened and now the market is waiting. And then I did want to point to gold as well, down 1.25% after we got that clarification. Remember Friday where there was all this kerfuffle in the gold market that there might be tariffs on certain amounts of bullion? Well, that seems to be going away, but we're still close to those records as well, Romaine.
A lot of market catalysts here on the day, 63.83 on the S&P 500, but go back 7 months ago when Wall Street was looking for the S&P to close out 2025 at 65.70. That implied a rally of about 8% on the horizon. But remember, those estimates, they got ratcheted down in a big way in April, and by mid-May, the average estimate was just 6,000. But a lot has changed since. Year-end forecasts creeping back to the lofty expectations, those lofty expectations that we saw back in early January. A Bloomberg survey last month, it showed expectations for 62.76 to finish out the year, and that average is about to go even higher. The newest survey out next week, and we've already seen some folks raise their estimates since that last survey. HSBC, which a month ago had one of the lowest price targets of 5,600, it boosted it last week to 6,400. Citigroup today going up to 6,600, and Goldman last month took its target to a near street high, 6,900. But therein lies the dilemma. While the renewed optimism is tied to wagers on tax breaks and rate cuts, a record share of fund managers in the Bank of America survey still see U.S. stocks as too expensive. That's particularly with economic headwinds breezing about, and that includes a key inflation report Tuesday that should provide intel on whether companies are indeed passing tariff costs onto their consumers, which in turn should provide intel into whether the Fed has the ammo to adjust rates.
I'm expecting the CPI will probably be, the core CPI will be above 3% when it comes out tomorrow. And if we start seeing numbers that look higher than the market's expecting, sentiment can change pretty quickly.
And that sentiment change, Vonnie, of course, has a lot to do with the economic data, and it has a lot to do with current market valuations.
Yeah, exactly. And if you look at the 10-year average, you would, maybe think that we were overvalued. But what does overvalued really mean? And are we ever going to get any answers to any of these questions that the market is trying to answer? We're at 22.29 on a forward PE basis for the S&P 500. Not the highest we've ever been by a long shot, but also we have been repricing since, earlier this year, clearly, since the inflation that got stoked potentially by the tariffs. Now, if we look at Ed Yardeni's reasoning behind all of this, he says there are 4 potential reasons why this market is so richly valued. Let's not say overvalued, but richly valued. And he goes through them. The potential for the digital revolution. We have also the potential for a rate cut in September coming. All of those could add to a roaring 20s scenario. It's not his base case, but it's there. And if that were to happen, he says the S&P 500 would trade around 10,000 by the end of the decade. So you can see there are many, many different scenarios. That said, Bank of America did its latest survey, and it showed that 91% of those that answered said that this market is overvalued. Nevertheless, they were still putting money in record amounts. Romaine.
Yeah, you're still seeing a lot of activity in the market as we continue to count you down to the close here on this Monday afternoon. Brenda O'Connor Juanas joining us right now, Senior Vice President and Financial Advisor at UBS. Brenda, great to see you.
Thanks for having me.
Are we overvalued, or as Vonnie said, maybe just richly valued?
So I think we're going to be at 6,500 on the S&P by next June. And what I look to and what I've been talking to clients about are really those Q2 earnings. We're more or less done. 75 to 80% of companies did beat to the upside at the top end of that range. Of course, we're going to see some slowing growth in EPS, probably 5 to 6% at the end of the year. But here are the messages I took away, Romaine, from those earnings. Number 1, revisions were minimal. Number 2, guidance is still pretty steady. And I also do think the OBBB is going to act as a tailwind to corporate profits in the next few quarters, and I think you'll see that in earnings and in the S&P returns.
With regards to the potential tailwinds coming out of some of the provisions in that bill, obviously a lot of it is tax related, but some of that was just status quo. It was kind of like the tax situation that a lot of the companies already knew. That continues to a certain extent with a few extra provisions added on. Does that just bring us back to square one, or are you seeing material appreciation from where we are?
Well, I think there's a little bit more of that. The other thing that I'm also talking to clients about is the U.S. dollar weakening and how that could also be a propellant for portfolio returns as well. I know we're all talking about the U.S. dollar down 10%, worst start in 50 years, but 40-50% of the S&P does generate its revenues outside of the U.S., even more so for some of those big tech names. And I think that in combination with some of the OBB stuff, some of it already priced in, is going to act in conduit to propel those earnings higher.
We've also seen companies buy back a lot of stock this quarter, right? I mean, every quarter, but capital allocation has been a theme, and what companies have been doing with it, and that's changing valuations ever so slightly too. Is it a material change thanks to some of the capital allocation decisions?
I think that for me, it's really changing my allocation between where I'm focusing both in the U.S. and internationally. So, for example, the first half of the year, I wasn't really focusing on that. I was looking towards non-U.S. stocks from a valuation perspective. We were seeing things like Europe trading at a 10% discount to historic averages. We were seeing non-U.S. stocks trading in the teens from a PE perspective, not in the 20s. That trend has already happened. We can see it reflected in half-year returns. Non-U.S. stocks are up over 10% versus their U.S. counterparts. Now I'm circling back and looking at other sectors within the U.S. where those buybacks are happening, but also in other parts of the world, not necessarily Europe. I think a lot of that's already priced in, but looking to places like India, for example, where you're seeing things like 2 to 3% inflation, where you're seeing GDPs of 6.5%. I think a lot of these factors will translate into EPS growth.
Yeah, that's fascinating because India was a darling for just a little bit, right? And then when relations deteriorated with the United States, I would have thought that investors would maybe get cold feet about India again, but you're all in.
I would say that we are confident that there's going to be some sort of resolution in the coming days and weeks. And I also think that all the macro that is supporting the economy right now is going to attribute to earnings growth in a relative basis that looks much more attractive than other geographies in the world.
This gets to the idea, too, of the U.S.'s role in all this. Obviously, a lot of the policies coming out of Washington have really reshaped relationships, or at least have started to. From an investment perspective, is the U.S. still going to be the primary place that you allocate? Meaning, is that your overweight in a global portfolio going forward?
So we are neutral in the U.S. right now. I would say we have to be very selective within sectors. No surprise, we still like tech. Again, look at those Q2 earnings. We think global tech EPS will be around 12.5%. I also like tech because it is insulated from a lot of this tariff talk. Especially, you also have this administration that is really focused on protecting and growing the industry, as we saw over the weekend.
You have a unique perspective, particularly with the types of clients that you deal with. Are they as enthused about public markets, equity markets, if you will, in the same way that we're seeing a lot of enthusiasm for private assets, if for no other reason than the potential return you get over public assets?
So I've been talking a lot about private assets with you, and again, this year it's a broken record. We've been adding to private credit here in this environment. The strategies that we have in our portfolios are delivering 10% net returns. And I think as we expect equity market volatility to increase, for those clients that need income, it is a stable way to get income. And also I'm looking at what's happening in these credit markets. Corporate credit spreads are coming in. That's giving me a lot of confidence to continue to add to that asset class.
We just learned in the last hour as well that the Fed search has expanded now. We're talking about 8 potential candidates. Does it matter?
Am I on that list?
You probably come out. That'll come out tomorrow.
I mean, it's 8. Why not make it 9?
If you disappear and we don't know where you are, then we'll know, right? If you start offloading all of your assets, we'll know why. But does it make a material difference to the decisions you make, given that it might have a material difference on the dollar, for example?
Right, and we've already seen a little bit of that. The questions of the U.S. dollar and its strength has been attributed to the Fed independence. At this point, I don't think that it's going to make a material difference. I think where we are in the cycle is indicative that we should be poised to start cutting rates momentarily. Again, we think we're going to start cutting in September. So I don't think at this stage that is a big concern of ours.
All right, Brenda, always great to talk to you. Great to have you here in person as well. Brenda O'Connor Juanas, Senior Vice President, and financial advisor at UBS, kicking us off to the close here in this Monday afternoon. When we come back, a conversation about big tech, a conversation about AI, but here's a twist. Jon McNeil, the co-founder of DVx Ventures, he says you can use AI to create a company. That conversation coming up in a second.
Well, if it's as easy as that. Plus, with investors in wait-and-see mode ahead of tomorrow's CPI, we look at what to expect with KPMG chief economist Diane Swonk.
And we're going to dive deeper into what's going on in the chip sector as we keep an eye on Intel CEO Lipschultz, scheduled to meet with the president later today, and comments by President Trump, of course, about those high-end chips out of NVIDIA and that 15% kickback to the U.S. government. Stick with us. This is The Close on Bloomberg.
Lithium stocks soaring after a Chinese battery producer said it halted operations at its largest mine in the lithium hub of Yichun. It's the latest hurdle for the market, which is undergoing a supply glut amid waning demand for electric vehicles. Let's bring in Bloomberg's Deaux. It seems like, we swapped from undersupply to oversupply awfully fast here, Joe, no?
Yeah. I mean, listen, you're talking about a critical lithium mine in China that has been part of what many consider the kind of oversupply, the glut that's happening in the market. For this announcement to come by cattle, I mean, I think this is huge, and you've seen it in the prices. There's the indication that the market is reading into that, hey, maybe we're actually seeing China address the concerns that the rest of the world has had, which is overcapacity and oversupply, particularly in this market.
Do we have any sense as to how long, or if they will stick by this, or is this going to be something that's temporary?
The short answer is we don't know. I mean, listen, I've covered metals markets for over 10 years here at Bloomberg, and the question always comes up, especially in copper and other various markets, like, well, are they going to do this, and is it going to continue for a long time? Like we saw the overcapacity questions with aluminum, and when they brought some capacity down. Ultimately, they brought those things back, but it's hard to tell. Like, this is a different time. This is a different approach by the government. So the questions in the market right now are, is this an indicator, not just of lithium, but in many industries across China that are considered overcapacity and in a glut?
We saw Ford unveiling plans to get back into EVs in a big way, for example. How soon might this impact global markets? How much of China's lithium is exported?
China likes to keep most of its own lithium. What it likes to export are the actual lithium-ion batteries. They like to be in control of that market. I mean, that was really at the center of the former president's massive climate bill, where they wanted to build out these EV production, but it was also batteries as well. So in terms of immediate impact on the U.S. market, I mean, it's hard to tell. I think one of the things we've pointed out in our stories is demand in the U.S. market was already down. Part of that is because the current president has taken a significant number of the benefits out of producing, the tax breaks that people were getting, some of the rebates that were going out there. I think we'll have to wait and see longer term what this actually means for the broader market. But in terms of the U.S. right now, I don't know if anybody's really having kind of a freak out moment.
I am curious. I mean, when you look across the metal space, I mean, we've seen so many movements that are been based largely on government actions, whether it's what's going on with China and cattle, obviously a little bit earlier with aluminum and copper tariffs. I'm really confused as to what's been going on with gold as of late. Like, are we tariffing gold, or are we not tariffing gold, or is it just bars, or is it coins, or like what? I mean, what should I be doing here?
The president said earlier today that there is no longer a tariff on gold. So I guess on some level we have to take him at his word. I guess we'll wait to see a proper proclamation or formal indicator put into the Federal Register that proves as much, because the whole hoopla came when the CBP issued a ruling saying, we do think there will be tariffs on 100-ounce and 1 kilo gold bars. Obviously, the president seems to have gotten that information. He's coming out and saying, no, that's actually not the case. So we'll just need a clarifier to kind of mint this one. Sorry, no pun intended. But hopefully the market can move on from this, because we did see a massive dislocation Thursday night and Friday morning.
And a lot of this has to do, too, I mean, like, there's a history behind this with regards to what types of gold can be shipped in. And the idea that Switzerland has always kind of sat in this sweet spot as, I guess, a processor. I don't know if that's the best way to characterize what they do.
A processor.
But the idea was that you wouldn't really tax that or tariff that. I mean, it's almost like taxing a dollar bill.
I said earlier today, it's the piping, right? If the pipes break, the water doesn't flow anymore. Switzerland is the piping. They're effectively the ones, if you have to move gold bullion from New York to London, it has to arrive into those bullion banks. in 400-ounce gold bars. That's just what it has to be legally. To do that, you send your 100-ounce gold bars, and they go through Switzerland, where they remelt them and recast them into these beautiful 400-ounce gold bars, and they get sent on their way to London, and vice versa. I mean, it's all procedural.
It's a fascinating process.
Yeah.
I mean, gold is still near a record anyway, Romain.
Yeah, I know, but I would like one of those. I've always wanted a gold bar, by the way.
Joe doesn't have any
I guess I have to
Have you ever held like a gold bar or like a silver bar?
Oh yeah, I have.
Yeah.
Oh
It's
yeah.
cool,
When I was
right?
a kid, we used to tour the mints and stuff. Yeah, and that was great.
That's pretty.
So I guess
that's pretty
maybe
awesome.
if I ever become
He
president,
said that
maybe
so
I can get
plaintively
one.
to you, Joe. He's like, I would like one, as if you have a stock of them.
I know, you have the
in the back.
connections. All right, Joe Deaux helps cover all things metals with us here at Bloomberg. And again, keeping an eye on those prices, not only in the gold space, but of course, also with lithium prices as well. When we come back, we're going to take a closer look at Paramount Skydance, the new Paramount Skydance. It's third day of trading, and it's really not any better than the first and second day of trading. We're going to talk to one of the analysts who just initiated coverage on the new shares and get his take on where he thinks this stock can go. That's coming up next here on The Close. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Adobe, the software company getting its second sell rating in a month, this time from Melius Research, which also slashed its price target to $310, the second lowest on the street. The analysts raising concern that AI itself is now Adobe's primary competition, which is making a once unique asset-light subscription model less of a moat than in the past. Shares down 2%. Next up, Elf Beauty, Morgan Stanley upgrading to overweight, upping the price target to 134. The firm saying consensus estimates too low, especially given the company's base business growth and upside from the acquisition of Rode. Those shares having a phenomenal day, up about 13%, best day since late May. And finally, Paramount Skydance, Seaport, initiating coverage of the newly formed company with a neutral rating. Despite having a sell rating on the former iteration of Paramount, the analyst is giving the new structure the, quote, benefit of the doubt, writing, stay tuned, episode 1 has just started. Those shares down again for a third straight day, this after falling about 11% on Friday. I'm pleased to say that the analyst behind that last call joins us right now. David Joyce is senior analyst over at Seaport Research Partners. And it must be kind of difficult to try to, assess a company like this, given that they haven't said a whole lot, publicly at least, about what they plan to do now that the deal is done. So I ask you this, David, what are your expectations? What do you think is next for David Ellison and Skydance?
So they've had the consistent message from when they announced the deal more than a year ago, focusing on making this a more tech-oriented company, which would mean that they would be leaning on the Paramount Plus and Pluto TV services and probably taking it a little bit deeper internationally, and relying on Ellison's relationships with the tech world, which increasingly means integrating AI into the processes of content production and what have you. But it's I think now that you do have the implicit deep pockets of these controlling shareholders, they can take a longer-term perspective and go in bigger to applying the technological strategies to kind of reinvent what it means to be a media company now.
What do you anticipate with regards to how they shape this company? Do you think this is going to be a story that's more organic, basically building up from within, or do you anticipate that maybe David will sort of, reach into his own pocket or maybe the pockets of other folks and try to figure out a way to maybe buy their way to growth?
I think it will be a combination, but basically there are three businesses to pay attention to here. The declining TV media business, which is still supported by live sports rights. I would imagine that some of those cable networks within their portfolio, they've got MTV, Comedy Central, Nickelodeon, and a host of others. I would imagine some of those could no longer be linear networks and be genre tiles, perhaps, within the Paramount Plus system. But they do have their own content creation, production capability, both from the Skydance side and Paramount. From the legacy there, but I do think that this will be an acquisitive company going forward. So that's part of the reason why I'm only going to a neutral rating, where I had sell on the Paramount just before this, because I thought there would be selling pressure related to the deal. So that was just a kind of a short-term sell rating that I had on it. But I went back to neutral because I think that they can reinvent what the company is, Maybe they get more into social media as a means for distribution. But I do think they're more of a buyer than a seller. Maybe they do some mergers, and I do think we are in this phase of industry rationalization. You've got things going on where assets are being separated at Warner Brothers Discovery and at Comcast and at Lionsgate. So maybe there is something to do, but I don't think this would be a seller, and that's normally where you would get the valuation premium.
Well, we've already seen, $7.7 billion deal for the next 7 years for MMA, UFC, right? What do you make of the pricing there? Does it seem reasonable?
So that's probably a reason why the shares continued to fall today after we came out with our neutral rating, our upgrade last night. It is a larger deal than expected. It's good for TKO shares, but it is $1.1 billion on average per year. The good thing is it's something that could help the Paramount Plus subscriber base grow, and it could reduce churn for the subs who are already there because they'll get access for the first time to the UFC pay-per-view fights, which before you had to pay specifically for. Now it's going to be part of your subscription. So it's something where they're probably losing money early on, but long term they're adding to their ad revenue. They're reducing churn, which increases the lifetime value of their subscribers. They're going to be growing subscribers likely, and they'll probably have a front seat to getting a chance at some international rights for UFC when that comes up. So I think in the short term it was a surprise that they won this, but it is probably good for the long term for the assets within Paramount Skynet.
Definitely for building, the powerhouse of content that David Ellison does seem to want to build. You mentioned that eventually they'll get more acquisitive. What kind of sizes of deals do you think we would see in that instance? I mean, are we looking at, an effort to acquire Warner Brothers or something like that?
I think they really do have a blank slate from here. It's there could be tuck-ins on the technological side if it's something that helps them accelerate their ad tech stack or reinvent their ad tech capabilities, measurement capabilities. Moving the Paramount and Pluto onto their own platform. But I think that there could be some large transformative deals in the future too. They will still look to generate cost synergies out of the current assets, and if they were to merge and do something with a Warner Brothers or the Versant, you never know.
Yes.
There would be some more economies of scale to come from that.
David, thank you so much for joining us today. That is David Joyce, Senior Analyst at Seaport Research Partners, and that stock down about 3.6% right now. Coming up, we're going to be speaking to Jon McNeil, the co-founder of DVx Ventures and former president of Tesla, about how his company is leveraging AI to save time and money when it comes to launching startups. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Vonnie Quinn. Well, Chinese OpenAI challenger Zhipu has released a new open source model that works off visual inputs, right? Well, I've studied my languages. But Romain, are you a subscriber to any of these, AI models?
Yeah. I mean, we pay for Perplexity and stuff. The Zhipu thing.
You pay, right? So I looked in Google, and one of the first things that searched for is Zhipu free?
Yeah. Well, I mean, the interesting thing I like, well, I wouldn't say I like, but the interesting thing I find about Zhipu is this idea that between them and DeepSeek, I mean, they seem to be pursuing much more of an open source model, which I guess some people would argue maybe has potential longer term benefits when it comes to the amount of people that will be able to sort of be involved in this, as opposed to some of the more closed models that we're seeing from companies here in the United States that maybe feel like, let's keep this stuff proprietary. And you kind of wonder what the direction is going to be.
Well, and this is a national priority for China. This comes from the top. This is the CCP in collaboration with some of these companies, and obviously they're sponsoring them with plenty of funds. But it's also just a very legitimate and deliberate approach. Whereas I'm not sure the US is quite taking such an open-hearted approach. But let's talk to our next guest about that, because I'm sure he'll have some thoughts about it. Because while the US and China are competing to lead the world in AI, DVx is using it to help startups get ahead through the launch of their AI builder. Jon McNeil joins us now. He's the co-founder of startup incubator DVx Ventures and the former president of Tesla. Before we get into the specifics of your company, Jon, just talk to us about that. Is the US pursuing the right strategic approach when you see the likes of DeepSeek, the likes of Zhipu coming for the US's launch in AI?
Well, I think you're raising a great question about open source models versus closed models, and that's beginning to shift in the U.S. too. I grew up in a farming area of the U.S., and if you can imagine, there's a farmer in town who just does his own thing, and year after year is trying to get better at producing more yield out of his crops. Then you can imagine the rest of the town all works together, and every week they get together and they share ideas about how to increase the yield of their farms. You would think that the group that is sharing ideas every week is going to get faster and better than the one that's just pursuing it by themselves. And that's the argument for open source. In the open source model, large groups get together and they share ideas and they make the model much better, much faster. And I think you can see that in the US, there's a signal that not only Meta is onto this, but also OpenAI, because they released their first open source models last week. So I think we're going to see the world move to a faster pace, and that faster pace probably will be built around open models versus closed models.
Yeah, there's definitely long been a split at OpenAI in particular, right? We saw a couple of models, as you say, last week. And it is interesting because when it came to the internet, China was pretty closed and it's censored and so on. But when it comes to AI and the building blocks, that said, let's talk about your company a little bit. Where do you stand on sort of offering all of what you've developed for free?
Well, I think, our venture studio model was already on a path to return more than 6x to our investors, but now we're supercharging that ourselves with AI. And we're deploying 80% less capital per company at DVx compared to 2 years ago. And that's not because we're being cheap, but it's because the fundamental economics of building companies has changed. So we've crossed into what we call the post-AI era in venture. And many VCs are still operating like it's 2021, raising massive funds and writing big checks. But if you can build the same company for 20% of the cost, our question is, what does that do to the entire VC model? So we've rebuilt our approach from scratch around this reality. We've developed our own AI libraries to help early stage companies overcome the barriers that all early stage companies face. And it's literally reduced our cost of capital to get a company started to Series A by 80%. So this, we think, is going to connect to something much bigger in venture as the path changes for how much capital early stage companies need.
So John, when you talk about AI tools and the idea that they would be shared across some of your portfolio companies, are these tools that they're using internally to build out their own business, or is this part of the actual product itself that they're producing?
It's really to build out their own business, Romain. It's a great question. So I'll give you an example. One of the things that every early stage enterprise software company faces is access to their customers' data. And the customer's data is often in a lot of different places in a lot of different formats. And so that stretches the onboarding time and that increased costs for everybody. And the onboarding time on average is 3 to 6 months in enterprise software. We challenged ourselves to say, how can we get that down to 2 to 3 hours? And the only way you can do that is with agentic AI, the kind of AI agents that can go out, gather the data right to the APIs, and then make the software workable. And so that's an example of one of the tools that we hand our new companies. Yeah. And it can be deployed within each of our companies to help them get to cash faster.
So forgive me, this is probably a dumb question, but if everyone is using the same tools, John, how do they differentiate themselves, or does that not matter?
I think we're differentiating the businesses based on what the business itself delivers. But in terms of the tools that help that business get up to speed faster, we feel like those can be common.
Yeah, I'm curious, what do you do beyond sort of automating things like, filing stuff in Delaware or, collecting customer information?
So we're using AI not only to build the product faster and to deploy it faster and have faster onboardings. We're using AI tools to help market those products, to help sell them, so develop the sales funnel, and bring potential customers through that sales funnel. So it's really changed the number of engineers we need per company. It's changed the number of sales and marketing people we need per company pretty dramatically.
How does your business model work? Is it software as a service? Is it a subscription model? Is it a one and done?
It depends on the company. So we launch companies off of our platform. The companies are usually software as a service, where it's a subscription or a consumption basis, and therefore looks a lot like the kind of structures that business software buyers are used to.
I am curious, John, when we get to this idea of sort of broader adoption of AI, and not necessarily in the sort of the ChatGPT sense that has kind of engulfed the markets over the last couple of years, but the idea that a lot of people are now talking about more deployment with regards to services, more deployment with regards to some type of hardware or some kind of physical device of some sort here. When you try to look for the winners in that space, John, do you think they're going to be, I guess, the traditional players, the folks that have, I guess, been sort of leading the charge on AI for the last few years? Or is it truly going to be newer companies, maybe ones that at least we may not have heard of, you might have heard of them, but the rest of us might still be oblivious to?
I think you're going to be hearing a lot about newer companies. So the AI companies that we've heard about for the past few years are building the large foundation models, which requires enormous sums of cash just on a monthly basis. They've developed the models that now application companies are coming and developing specific applications, whether that be for sales, pharma, engineering, manufacturing, et cetera. And some of those companies you've already started to heard of. So you've started to hear about Cursor, which is a coding assistant that helps engineers generate code much faster at a higher quality than they've been able to in the past. That's an example of an application company that's built on a foundation model company. Anthropic is the engine that they largely use. And so I think you're going to see and hear more and more in this era about the application companies. They take far less capital to build because they're not building these huge models that require huge training budgets. And they're solving, and what we're trying to do is solve real world problems with these for the enterprise.
All right, John, great stuff, and love checking in with you again on this. Jon McNeil is the co-founder of DVx Ventures. A closer look here at the use of AI, agentic AI to be specific here, in actually building out companies as we now sort of enter a new phase in the AI race, and it's raising a lot of questions about the old phase of that race and maybe some of the companies being left behind. Intel, of course, key in that space. The shares higher here on the day, though well off the highs of the day. A lot of concerns about Intel's future in the chip space, in the AI chip space specifically, because of its CEO, the CEO apparently in Washington meeting with President Trump. We're going to focus on that as our stock of the hour when we come back here on The Close on Bloomberg. Keeping an eye on shares of Intel. It is our stock of the hour. We're also keeping an eye on the CEO of Intel, Lipschultz, who's set to meet with President Donald Trump. This coming off of the president's criticism of Tan because of his alleged ties to China. Tan has already responded, saying that he's looking for the full support here. You see the shares there up about 4% on the day. Let's bring in Bailey Lipschultz, who covers stocks for us here at Bloomberg. And Intel is an interesting story, probably one of the worst performing, at least of major stocks out there over the last couple of years. And Lipschultz was supposed to be kind of the answer to all of that.
Stepping in March, going to revitalize Intel, bring in fresh blood, fresh ideas. And there was a lot of excitement from Wall Street with new management. But now, as we seem to see every day, someone kind of getting caught in the crosshairs of this administration. Obviously, as you mentioned, kind of that post on social media last week, we saw some weakness. But now, after Bloomberg reporting that they're going to at least meet in D.C., stock, as you mentioned, up quite sharply, but pulling back from those gains. A lot of the questions around what fruit is born from this meeting and what does it actually end up meaning? Yeah, exactly. I mean, Lipschultz already had problems before this, right? I mean, what does he want coming out of this meeting? Does he just want to stay in his job, or does he want to, butter up the president somehow for some support in some way? I think the latter is the hope. Obviously, the big question is Intel is one of, if not the only, U.S. manufacturers of chips, and they've been kind of delaying opening that Ohio plant. There's a lot of uncertainty about kind of bringing some of that manufacturing back, and the big kind of reading of the tea leaves over the last few months has been, what kind of partnership does the company need? What kind of a customer does the company need to really ramp up production? Otherwise, if you're losing money and for all intents and purposes, Taiwan Semi's eating your lunch, the question is, what's next? Well, that's what's kind of surprising about the way that the administration has treated this company. You would think, given our limited manufacturing capacity here in the U.S., you would embrace those companies that can do it, which is more or less Intel at this point. And I know the Biden administration tried to do that with the loan program. Is there any sense here, just from an investor perspective, that maybe some investors are counting on that at some point the White House will realize that if you are looking for a homegrown chip champion, that Intel might be one of your best bets? I think the issue, when you look at the performance, even back to March, year to date, however far you want to zoom out, the big thing is this is a very capital-intensive business if you lean into manufacturing. And if you look at Taiwan Semi and your ability as an investor is to deploy capital, well, I'm going to bet on the winner, the company that has these big contracts, the company that's been dominating and has been at the forefront, as opposed to kind of taking a bit of a flyer, hoping that this U.S. corporation can kind of figure it out. And that's been the big debate, even when I go back to the fall before the shakeup at the helm of Intel. The big question has been, what is next? What are you actually going to do? To your point, if you look at the stock on a few years chart, you wouldn't know that they're in semiconductors, especially when you lay that over with how some of the other companies have performed.
I'm sure phone calls were placed to the office of Jensen Huang for some pointers as to how he should act with the president. Our thanks to Bailey Lipschultz there. That's Bloomberg's Bailey Lipschultz, who covers IPOs, chip stocks, all sorts of things for us. Coming up, we're going to take you to the closing bell with Anthony Saglimbene. He's Chief Market Strategist with Ameriprise Financial. This is The Close on Bloomberg.
I think we're going to be at 6,500 on the S&P by next June. And what I look to and what I've been talking to clients about are really those Q2 earnings. You know, we're more or less done. But here are the messages I took away, Romaine, from those earnings. Number one, revisions were minimal. Number two, guidance is still pretty steady. And I also do think the OBBB is going to act as a tailwind to corporate profits in the next few quarters. And I think you'll see that in earnings and in the S&P returns.
6,500, a potential possibility as we count you down to the close, 63.76 and change right now on the S&P 500. And we should point out, we've kind of been in a relatively tight range, kind of 6,200 on the bottom, roughly almost 6,400 on the top. A market trying to break out to the upside, but there's a lot going on, Bonnie, including a big CPI report tomorrow.
For sure, definitely treading water today. But you're right, Romaine. We have been in a range for quite some time now, and there are so many questions that still remain to be answered. And I go back to a note last week from, I believe it was TD Cowen, talking about the Overton window. So at one point, 25% tariffs seemed massive and something the market couldn't get over. Now that doesn't seem so bad, maybe, after all. So the market narrative changes, slowly and then fast.
And I thought it was interesting too. You had a few banks raising their price targets today, but Bank of America had their weekly survey out, hedge fund manager survey. And I thought what was so curious about it was how the majority of folks in that survey basically said stocks are overvalued. Yet the majority of those folks in that survey are still overweight U.S. equities. So it's kind of the weird dichotomy here where everyone kind of is looking at this market. They know that maybe something's not quite right, but no one wants to miss out on it.
In a way, it goes back to that Goldman Sachs note last week as well, right? Where literally the macro trader said, if you sell in this market, you almost look crazy because no one is selling, it seems. Yeah, a bit of a pullback here on the day, down about 0.3% on the S&P 500 as you get closer to those closing bells. Anthony Saglimbene steps up to the plate right now, Chief Market Strategist over at Ameriprise Financial. And I guess this is the parlor game right now, Anthony. When you look at just how this market has done this roller coaster from those highs we saw at the start of the year to the lows that we saw in April to now, I guess basically where we are with fresh record highs despite the drop today. And a big question as to whether that's it, whether there can be further gains or whether we've maybe seen the best of what this market has to offer, at least in the short term.
Yeah, no, I think you guys are highlighting and touching on it. It's fear of missing out. We've had a pretty volatile couple months. But since those April lows, the markets have gone straight high or straight higher. But you do point out something very interesting is over the last couple of weeks, we've been in this tighter range. We've had earnings that have been very strong. So companies in aggregate are surpassing analyst estimates. Guidance from big tech has been very strong. We've seen some uncertainties around trade and tariffs, but then we get some exemptions. And so investors feel a little bit better about the macro environment. And I think what we're waiting on right now is that CPI print tomorrow and then the retail sales report on Friday. I think if we get some macro data that supports a still solid economic backdrop, you could see stocks move a little bit higher from here. Our base case target for the S&P 500 at the end of the year is 6,500. And I think there's still a little bit of upside left in the market right now. It's interesting you bring that out because this does seem a market that really is on edge. And I mean that on edge in a good way, meaning they're sort of looking for any excuse to take this market higher. So if we get an inflation report that is, I guess, relatively benign, and I know the estimates are for some increase in core CPI, but nothing like overly dramatic, and retail sales expected to hold at about 0.6% on the growth rate. If we do get those numbers, and if they do surprise in a positive way here,
is there this sense that there are more people on the sidelines willing to come back into this market and not just the folks currently in the market willing to double down on their bets?
I think that's right. And I think what we've seen over the last week or so is more Fed officials come out and say they could support further easing because labor markets are starting to slow a little bit. And so if we get an inflation report that's around expectations, if we get a retail sales report that's also around expectations, then you have a macro environment that's potentially supportive for a September rate cut. And if we do see markets start to kind of work that in and maybe some cuts further out into the year, then I think the profit backdrop is very strong. We're going to get a report from NVIDIA on their profits here towards the end of the month. From all accounts and what we've heard from other big tech companies is those earnings are likely to be strong. And so you have some tailwinds here that could bring some people off the sideline into this market. And I go back to that fear of missing out until we see catalysts that the economic backdrop is slowing or tariffs are having a material impact on inflation, then I think we would be a buyer of any volatility that potentially arises because the fundamental backdrop is still pretty solid.
Yeah, it's so strange, Anthony, isn't it, that we're in the middle of August and we still don't really know where we are for the rest of the year, inflation-wise, labor market-wise, even, Fed chair-wise. We now have 8 candidates apparently that are being considered for potentially the next chair. And we also have, a range of outcomes from the Fed, from market participants, which suggest that we might have 0 cuts to at least 3 cuts by the end of the year.
I think what's very interesting is when you look at these big macro data points like inflation and retail sales and ISM, manufacturing and services activity, I think what we're finding is it's hard to find impacts from tariffs in that big macro data set. I think what we're likely going to see over the next couple months is that tariffs are really case by case, company by company, industry by industry. And if we do see macro data that's relatively supportive of a solid economic environment while labor markets are cooling a little bit, it does provide room for the Federal Reserve to cut interest rates, which is supportive for equity markets. And on top of that, we have very solid earnings trends. And so big tech and AI are driving S&P 500 earnings higher. If we have a stable economic backdrop, more industries like financials and industrials can participate in some of that earnings growth. And I think you could have a decent setup for the end of the year here to kind of push markets past current levels.
Yeah, there's so much to make, an investor nervous out there, though, Anthony. I mean, what would you do here? Would you at least take the foot off the brake, the foot off the accelerator even when it comes to the Mag 7, let's say?
Yeah, what we're doing is we're overweight technology, but really selective in high-quality AI-driven companies. But below that, we like areas like financials. You're starting to see capital markets ease up a little bit, more IPO activity, more merger and acquisition activity out into next year. Utilities act as a safe haven, but also benefit from the build out of the AI infrastructure. International stocks don't have the type of technology exposure that U.S. markets have. So from a portfolio standpoint, diversifying your portfolio across U.S. and international in different sectors and industries makes a lot of sense and can help balance some of the uncertainties that are still out there right now, tariffs being one of them.
All right, Anthony, got to leave it there. Anthony Saglimbene, Chief Market Strategist with Ameriprise Financial, as we count you down to the closing bells with the full breakdown of all of today's market action right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bonnie Quinn, taking you through to that closing bell with a global simulcast. It started with Tim Stenovic in the radio booth, Isabel Lee in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms, television, radio, YouTube. Tim Stenovic here on an interesting day here, a day where we see the markets move lower, only fractionally. But of course, this is ahead of some key economic data this week.
Yeah, that's exactly what I'm watching. Tomorrow, we're going to get CPI. Later this week, we will get some PPI. We'll get some sentiment data. At the end of the week, we'll get retail sales. It's all trying to paint a picture, Isabel, of what exactly the Fed is going to do in September. And of course, we'll hear from officials of the Federal Reserve in Jackson just a little later this month.
Maybe risky assets have faltered, but my eyes just stuck on Bitcoin because we see the coin really just rising. I feel like it's a perfect storm for this. Of course, all these smaller altcoins like Ether is also edging higher, but really, I can't take my eyes off of Bitcoin.
Oh my gosh. Remember when people used to take August off, though? Seriously? I mean, we're in the middle of August and it's really a fascinating market, even if, you know, on the surface, we're not moving too much today, as you all say.
Yeah, and it gets to this idea, too. We talk about the idea of catalysts to move the market, but sometimes the lack of catalysts also can sort of be an upside for markets as well. It'll be interesting to see what happens at 8:30 a.m. tomorrow, Tim. But also this idea that, you know, we just got a 90-day extension on the trade truce with China, if you will, and a few other concessions by the president that might be a net positive.
Yeah, and, you know, wait to hear the latest coming from the White House, too, with the Intel CEO, who's supposedly there right now, Romaine.
Yeah, absolutely. We should point out CNBC is reporting that Lipschultz was seen entering the White House grounds. A crucial meeting here for a company that has obviously been looking for some sort of a lifeline here with regards to its role in the broader chip ecosystem. As we give you the numbers here on this Monday afternoon, it is red across the screen, though we should point out that the losses across the board are fractional. The Dow Jones Industrial Average down by about 0.5 percentage point, the S&P 500 down by about 0.25 percentage point, and the NASDAQ down by about 0.3%. The Russell 2000 only dropping about 0.1% on the day, though, Tim, I do just want to point out Dow Transports, that was your big laggard on the day. As a group, they were down 1%.
Well, looking at the S&P 500, how it closed today, we did have 177 stocks move higher, 320 stocks did move lower.
Yeah, and if you look at the IMAP, I mean, it's more interesting of a day than it would seem. So you have most areas in the S&P 500 lower, but as Romaine said, fractionally, and several fascinating stories within those. You know, for example, the energy story, there was, you know, a major decrease in energy stocks today, but you have the lithium story factoring into that, you have gold factoring into that, you have oil factoring into that. So it's really just a fascinating market, all told. One of the sectors in the green still, though, consumer discretionary, so Procter & Gamble up 1% today, and that really helped, you know, at least stave off the worst of the losses.
Some really interesting stories playing out, too, when it comes to individual movers. I got the gainers today with Carol out of office. I want to start with Intel, as Romaine mentioned. Lipschultz, the CEO, who was called out by President Trump late last week in a social media post, according to CNBC, has been seen entering the White House. Investors liked what they heard early this morning when the Wall Street Journal did report that he was set for a meeting at the White House today, 3.7% to the upside for Intel. The person who said this and was familiar with the situation asked not to be identified, discussing private matters. The president did write that post on Truth Social Thursday that Tan should step down as CEO of Intel, describing him, quote, as highly conflicted. Also watching TKO Holdings, 10.2% to the upside today. Paramount has acquired the exclusive rights to show all events from the UFC in the U.S. over the next 7 years. It's a $7.7 billion deal. David Ellison is paying UFC's owner TKO Group Holdings more than double what it received under a previous deal with ESPN, which of course is owned by Walt Disney. And David Ellison is hoping the Mixed Martial Arts League will drive millions of viewers to the company's streaming service. Once again, TKO Group Holdings up 10.2% today. And finally, did you guys see what happened with weed stocks today? Marijuana stocks?
I did.
Tilray up 42% today. It was one of the most actively traded stocks in the U.S. today. This after a report that President Trump was considering reclassifying marijuana as a less dangerous drug. The report cited the president's remarks made during a fundraising event. This, according to people familiar with the matter, it highlighted a potential new scheduling push from the administration. Once again, Tilray Brands up 42% today.
I just want to just add an honorable mention there, and that's actually Fannie Freddie. I was just keeping an eye on them. The shares rose 15% today, and that includes the 20% gain on Friday.
Is this a Bill Ackman move?
It's now $11.48 a share. It may not seem like much, but a milestone here. It's actually back to its highest level since 2008 when it went into conservatorship back in September 2008. Of course, this was, more a $100 stock at one point back in 2007, 06, but still a clear milestone here that maybe there is something afoot.
Well, we still have earnings crossing right now. GoPro, the maker of those cameras, coming out with second quarter revenue.
Is it public?
It's still public. It has not been acquired.
Okay.
We could do a whole story about GoPro. It's pretty fascinating that this is still a public company.
I still have one, yeah.
Yeah, I mean, but you know, a lot of people would argue that phones, you know,
well, maybe
really
when
hurt
AI
them.
needs a whole bunch of, you know, photographs and stuff, maybe then they'll buy the IP from GoPro or whatever.
Yeah,
idea?
that's a good point. Second quarter adjusted revenue came in 18% below what it did at the same time last year. Second quarter adjusted loss per share coming in 8 cents versus a loss per share of 24 cents last year. In the after hours, shares moving higher right now by about 4.6%.
Let's stick with the decliners. Deaux is down 8% after the company cut its annual adjusted EBITDA forecast. The company also said that industry-specific challenges and less favorable weather conditions in much of Central America really put pressure on their industry supply and, of course, their sourcing costs. That, as well as really just weak market demand. Up next is Humacyte. This is also a big loser, down by almost 30%, the most since March. So this comes after the maker of bioengineered human tissue product, that's a mouthful, reported revenue that fell short of expectations. And I want to end on a fun note, although maybe it's not so fun because shares are down by almost 5%. Hershey, so the chocolate maker, is trading lower as cocoa futures climb. So this comes after renewed concern about weaker African corp forecast in the coming season. And on July 22, recall that Hershey said it is raising prices on its candy due to, again, historically high cocoa prices.
Real quickly, let's check in on what's happened with yields on this day. We did see a slight downdraft pretty much across the curve, but they were, as you can see, modest declines to be sure when it comes to yields. In fact, basically not much of a decline at all. Call it unch on the day, but it gets to this idea of a market that remains in stasis as, of course, everyone now awaits the economic data, and the economic data, of course, as it sort of will relate to what the Fed may potentially do next. Will they have enough ammunition to actually come out and cut rates at their September meeting? All right, let's go back to earnings. Archer Aviation crossing the wire right now. The company, as expected, did post a loss of about $206 million. The company also reporting operating expenses that also rose. That was expected as well. However, the EBITDA loss did come in a little bit higher than expected, $118 million and change. And that does appear to be maybe part of the reason why you're seeing the shares move a little bit lower here in the post-market trade, down about 7%.
Do you guys have Labubu? Any Labubu?
You're excused. No, no.
No. Romaine?
No.
Not a big Labubu person?
I am. But I gave them all away.
You gave? Oh. That's so kind of you.
Yeah, I bought like a big box of them like a few weeks ago, and I gave them out to my nieces and nephews and a couple of adults in my life too in the bureau.
It's interesting because I have no Labubu from Romaine on my desk.
Well, sorry, that's a hot commodity, Tim. I had to portion them out, you know.
The Dubai chocolate, trend as well. It's a hot commodity.
Awful, yeah. Go ahead.
Crumble cookies.
Crumble.
Matcha.
Matcha.
Amanda Mole has this great piece. She writes about consumers for Bloomberg Business Week. She's got a great piece about TikTok trends and the way that they're driving random consumer spending. And it's kind of baffling, not just her, but the way that people are thinking about how to study what consumers are spending money on and what they're prioritizing right now.
You know, it's funny because I've heard of most of those before, but I really think I've learned about a lot of all of those trends just from TikTok itself, from people talking about TikTok.
Yeah, that story though was good because I think it really gets to the idea of sort of what drives virality, and particularly for those of us of a certain age where it was a lot of effort to even get your name or your product out there in the zeitgeist. And now, if you can sort of hit a nerve on social media here, you can, do it. I mean, you go down the street here to.
I was just going to talk about other kinds of nerves, those in jellyfish, but we're not going to talk about that story apparently.
You gotta wait for TikTok.
The one point you brought up, though, is that how these are material things that really require people to come together. So maybe we're not all digital for now.
All right, I'm ready for a Labubu, Romaine. You can still bring me one.
All right, when's your birthday? Just mark
we
it
need
down.
to translate that for people who don't know what Labubu is.
Isn't it a stuffed animal?
Because that sounded very odd.
A six-year-old showed me.
Tim,
it's a stuffed animal, right?
It's time to say goodbye. You're not going to be Carol.
Okay.
I want to see what's on Romaine's GoPro. Do you still take that thing out and look at it like a slide carousel or whatever?
It's largely me hiking with my dog and then basically me getting tired and sitting on a rock. So, yeah.
All right.
I thought it would be more action involved.
We got to run.
Yeah.
We got to run. For more earnings and the latest on Labubu, keep it here. It is going to do it for our cross-platform coverage of the market close. We'll be back with you, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television, a closer look at markets and a closer look at tariffs, particularly when it comes to earnings and particularly when it comes to market buzz and the impact on stocks going forward. Kristen Bitterly joins us in just a second, the head of Citi Global Wealth at Work. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Romaine Bostic, of course, coming off of last week's gain. A little bit of a pullback here on this Monday afternoon for U.S. equities and what is promising to be a relatively busy week, at least when it comes to macro data. Of course, a big CPI report tomorrow, retail sales later this week, as well as a read on consumer sentiment here. All of that, at least for the day, pushing the S&P back below that 6,400 level. Only a drop of about 0.2% here, but a little bit of stasis, I think, till people get a little bit more clarity as to what those numbers are going to look like. Meanwhile, there was a lot of activity in the commodities space. You saw cocoa prices at one point hit their highest levels in several months here. A lot of concerns right now about weather conditions overseas. Spot gold actually took a little bit of a leg down. This after a lot of confusion as to whether gold or gold bars or what form of gold would actually be subject to U.S. tariffs. And keep an eye on Bitcoin now, right around that 119 mark, Bonnie, but at one point on the day, it did trade above 120 at an intraday record high.
Well, interesting you should say that, because I picked out Coinbase as one of my stocks because all of those crypto universe stocks did seem to rise today. In fact, Coinbase coming down a little bit towards the close and ending up less than 3%, but at one point it was more than 5% higher on the day, 6% I think even at one point. So quite a lot of volatility, at least in that upper range. Apparently, a lot of treasury companies are buying Bitcoin today. I mean, who knows? There's 200 plus of them, right, around the world globally. I did want to point to TKO because another fantastic deal for the Endeavor, subsidiary, majority owned by Endeavor, obviously, but WWE and now UFC going for, billions and billions over the coming years. A really massive deal for TKO. And you imagine that Dana White is very happy today. Palantir finally came to the end of its most recent run. We'll see if it has another run, but it's certainly trading at 225 times earnings, which is whopping. Had 5 days of gains and today down 2.3%. I mean, I think those who have been invested for the $2,500% run are quite okay with that. And then Romaine picked out Fannie Mae earlier. I did as well, up another 15% today on top of the 20% plus on Friday. Obviously, the idea is out there. It's percolating. Many analysts are saying, look, this cannot happen this year. But we did see more banking CEOs go through the White House to talk about Fannie Mae and the possibility of, perhaps some shares getting sold this year. We also have Bill Ackman coming out and saying a merger between Fannie Mae and Freddie Mac would be the perfect way to do this. So a lot of chatter. Bill Pulte, of course, constantly tweeting about this, getting them out of conservatorship, or at least in some fashion this year, needing to get done. So that story continues to percolate, and investors are buying what are over-the-counter Fannie Mae stocks at the moment.
A look at the individual stories here in the market on a day where we saw the equities basically kind of stall out a little bit here. Not far off of those record highs, but a lot of folks on Wall Street refraining from making big bets ahead of key economic data this week, including tomorrow's CPI print, which could maybe provide some intel on whether companies are indeed passing along tariff costs onto their consumers. Our next guest says, despite continued tariff threats from Trump, the market remains resilient, possibly underestimating the potential impact on corporate profits and prices. Joining us now is Kristen Bitterly, head of Citi Global Wealth at Work. And Kristen, I do want to start with that CPI report tomorrow. Yeah. We should point out most of the estimates by economists looking for really incremental increases in those inflation rates.
About 0.3% month over month.
So nothing overly dramatic. And we all know that one inflation print is not necessarily a trend. But I do wonder if you worry at all that given this sort of, I guess, kind of honeymoon period we've had with regards to not really seeing a huge amount of tariff impact, as to whether we should prepare ourselves for some.
Yeah, so as we've been saying, base case is best case here. We don't want surprises in terms of what the market is anticipating. That being said, I think the jobs report and the employment data is going to be much more telling going forward than the inflation print tomorrow. And the reason for that is, where could we see a surprise that would change the trajectory of rate cuts? So obviously, if it comes in more modest than expected, that could maybe accelerate some of the pricing of rate cuts. But if we get a surprise to the upside, I think what the market is going to do is really try to parse through what is is actually attributed to tariffs being passed through. And a lot of that is being interpreted as a one-time type adjustment. And so could that ultimately be explained away in terms of the inflation impact? So we're watching that closely. Everyone's going to watch the goods component of it. Yeah. But I think almost we're anticipating some should flow through. It's just a question of when.
But my question is, too, does it necessarily have to flow through? Because we pretty much know the tariff rates, and not for every country, but we have a general sense.
Do we know the tariffs?
Well, yes. Well, someone knows them. We know them as of right now. They may be different tomorrow, but as of right now, we have a general idea of what the sort of average baseline is going to be. And we can kind of extrapolate based on our economic activity, how much of a hit that is to importers.
Absolutely.
So whether it hits you in your pocketbook, you and me in our pocketbook, or whether it hits the companies themselves, there is an impact.
Of course.
So why do you not think that the market is a little bit more concerned? Is it because they already priced in those negative scenarios?
No, I don't think the market is pricing in the negative scenarios, particularly when it comes to earnings. And so I think what's happening right now is because we don't have certainty around tariffs, we know that, you know, the estimated impact of tariffs is around 15 to 17%, somewhere in that ballpark today. It could change, but because there's this constant changing target, I think the market is almost hesitant to price that in. And until we see that come through in corporate earnings, we're not going to really see the downward pressure on equity prices per se.
How much are you fielding calls and client questions about private versus public these days?
A lot. So I think like when it comes to the opportunities that exist within private markets, this is one of the things when we look at valuations in public markets. Obviously, we can have the debate around what's marked to market and what isn't, but in public markets, particularly for some of the themes like AI being the dominant one, which is really fueling a lot of this growth, we see a lot of the prices within public markets, they're just priced to perfection. So we see a lot of demand, particularly with the long-term secular growth trends, for investors to be able to express that in private markets. I think the other thing, too, is obviously given some of the changes potentially from a regulatory perspective and being able to access private markets in different types of retirement plans and things like that, you could see the demand side of the equation continue to grow.
So is that the quote-unquote alternative du jour now? Is that the favored alternative, or what are investors asking for?
So I would say that the interesting thing from an alternative standpoint is the way that we look at it at Citi Wealth is really across a number of different areas. It's obviously private equity and credit, real estate, and then hedge funds. If I was going to say, based on our experience, where have we seen the biggest inflows year to date? It's actually been in the hedge fund space. In some of those strategies to both mitigate volatility and dampen some of the downside exposure, but also in some of the tax-aware investing and some of the innovation that has happened there within the hedge fund space. So I would say this is a unique year where you tend to see more flows into private equity. Year to date, just given some of the volatility and uncertainty, it's been definitely into hedge funds.
How much of that is also tied, and particularly on the hedge fund side, this idea that people are looking for a little bit more guidance given all the volatility in the market? I mean, we came off a bear market where if you just bought, the SPY or some other broad market ETF, you were going to make money, and considerable money.
Of course. Like if you look off the depths of April and the rally that we've experienced, obviously being long equity beta has been a positive trend. But if you go back to the beginning of this year and then just look at the uncertainty that we've had, whether it's been from policies to taxes, I mean, there's been a lot for investors to navigate. So having some uncorrelated exposure, having some exposure that can dampen the volatility and diversify your returns has been attractive.
When we talk about the longer term, so, I mean, just let's get past, the next year or next 3 years for that matter.
The next day.
Right. There's a question about the structural themes of this market. You mentioned AI. I know a lot of people have come in this program. They talked about longevity, multifamily housing. There are broad structural trends in our economy that will outlive whatever, is going on here and now. Where do you steer your clients in that? And let's just take AI because that's obviously the obvious answer. But there's got to be something else beyond just AI.
So AI is the obvious answer. But even within AI, when you're looking at public markets and private markets, I think you almost need to bucket it into three different themes. You almost have to say, what is the direct exposure to AI? And that's the infrastructure, the data centers, all of those kind of direct plays, semis, et cetera, the large cap, mega cap tech companies. Then the second bucket is almost the productivity gains. And so when you look at companies that are actually deploying and investing in AI and are seeing that from a productivity standpoint, whether that's in top line revenue growth through redeploying their labor force or whether it's through expense saves. And then the the last bucket is almost like the industries that are not as impacted by AI. So I think like within public markets and private markets, there are still opportunities, particularly within public markets. That second bucket is what we're really starting to see take place. Who are the companies that are actually deploying, investing, and you're starting to see that impact their bottom line?
Well, we were just talking with a venture capitalist earlier today in the program, and he was talking about this idea of how creation of companies now they're using AI tools internally to sort of speed up that process.
Absolutely.
And a discovery process that he said what would have normally taken a couple of years, and you say, or what would you say, 3 to 4 months, and he could take now 3 to 4 hours.
And also for pennies on the dollar.
Yeah.
Curious as to, just very briefly, commodities. Any place for them at the moment? Is it too volatile?
Well, I mean, you're seeing a lot of volatility in commodities. I think we have to talk about the obvious one in terms of gold and what we've experienced, and particularly with some of the downward pressure on the dollar. I think there's a place for it, absolutely. But even when you look at the exposures that we have within our portfolios, it's relatively modest and more of a diversifier than anything else.
All right, Kristen, thank you so much, and for coming into studio as well. That is Kristen Bitterly, head of Citi Global Wealth at work.
Just want to get you some earnings, Vani. This on Oklo. This is the maker of small nuclear reactors. Of course, this is a stock that has more than tripled in value this year alone. Out with their earnings, the company, as expected, posting a loss per share, but it's a loss per share that actually is wider than expected of about 18 cents. They don't have a whole lot of revenue. Again, this is a relatively new company, but their operating expenses also coming in higher than expected. You see the shares slightly higher here in the after hours trade, and a lot of that seems to be on some of the commentary in the release. We'll get you some more details on that, Vani.
All right, one more down for earnings season. Coming up, from AVs to EVs, GM and Ford ramping up their investment plans. We'll discuss both automakers next. This is The Close on Bloomberg. Shares of GM closing the day in the green following plans to develop a new driverless car. The automaker looking to lure former employees of its defunct Cruise AV business to focus on autonomous cars for personal use. This is all according to people familiar with the matter. Joining us now to discuss is Bloomberg's Detroit bureau chief, David Welch. So David, where is all of this coming from? There seems to be a little bit of a change in strategy, and where will they get the talent from?
So a few months ago, General Motors hired Sterling Anderson away from Aurora, which is a truck. Well, they do all kinds of AVs, but they're mostly focused on trucking right now. He's their chief product officer, and now he's head of product for GM. And his background was developing autopilot for Tesla and also working more recently for Aurora. So he's come into GM and he wants to kind of re-energize the work that they've done on self-driving vehicles, even after Cruise. Mary Barra, the CEO, has talked about this a little bit, developing a personally owned AV that they would sell to people. Any car you buy, you'd have the option of maybe turning on the self-driving service of the vehicle whenever you're on a long road trip or something, or you're stuck in heavy traffic and it's not so fun to drive. And they wanted to develop this for a long time. Everyone thought it would just be an outshoot of Cruise, but now Cruise is dead. So Sterling Anderson has to go out and hire some new talent. And part of that, he said in an internal meeting, is to maybe bring back some Cruise people or just find new talent out there out in tech land in San Francisco. GM's got a tech office in Mountain View, California, and they could add some people there. But they'll hire people anywhere if they can get them, if they can get the right talent in to make these vehicles again.
So what do I make of this, David? Because when I saw your story cross the wire on GM, this came, I don't know, just a couple hours after there was a big story about Ford actually sort of, I don't know if it's doubling down or whatever you want to call it, but basically investing more money into its EV platform. Should I be reading something into all this?
I think what's happening with both of these technologies, whether it's autonomy or plug-in vehicles, everyone has had to look at where the world really is in terms of both technologies' development and what the demand is for them and recalibrate what they're doing. In Ford's case, they came out with the Mustang Mach-E and the F-150 Lightning. These were basically gasoline vehicles that they had done heavy engineering to and retooled to put an electric drivetrain in them, and it was a very expensive way to do it, and they couldn't get the maximum battery in there, so the cars didn't go as far as some of their competitors on a single charge. So you have an expensive vehicle that loses money, and consumers are worried about how long it can go. Then they talked about a big 3-row SUV. They saw SUV demand was sinking. They dropped that, but they've been working on this new low-cost EV architecture that they can make a bunch of vehicles off of, and now they're saying they're going to have in a few years vehicles that can sell for under $40,000 and make money. And that's what everyone has to do, but it's taken a while to get there technologically to be able to sell vehicles that are affordable and don't lose billions of dollars.
Hey, David, got to leave it there. David Welch, Bloomberg's Detroit Bureau Chief, out there, a closer look at recent developments on GM and Ford. Remember Kodak? They're actually out with news right now. Their earnings just released, but the key phrase is at the bottom of the press release: going concern. The company raising a going concern warning, which sometimes, but not always, is the prelude to a potential filing for bankruptcy protection. The company not saying that is happening, but alerting investors to the possibility. Keeping an eye on shares of Kodak down in the after-hours trade after the company issued a going concern assessment. This has a lot to do with a potential raising of capital that it had planned to use to fund a payback on preferred stock and debt obligations. But it says that because of certain provisions related to its retirement plans, some of that money may actually have to go towards that. The company says that's out of its control, and as a result, it has to alert investors to the idea that it raises doubt, substantial doubt, to be specific, about the company's ability to continue as a going concern. We'll keep an eye, of course, on this story. We should point out, of course, Kodak had bankruptcy proceedings back in 2012 before emerging and getting back into the public market. Those shares now down 11.5% in the after-hours trade.
Yeah, and still almost 4,000 employees up in Rochester and New York, so we'll definitely keep an eye out on that and those shares dropping like a stone post-market. We also have July CPI data out tomorrow morning. Economists expecting inflation to rise in July as tariffs filter through to retail prices, according to a Bloomberg survey. Let's bring in KPMG chief economist Diane Swonk. Diane, definitely want to talk to you about the labour market as well, obviously in light of Kodak's announcement as well. But first, we have to ask you about CPI. Are we going to see a material difference tomorrow morning?
Well, I think we're looking for 0.2% on the overall and 0.3% on the core. That'll push the core back up above 3% for the first time since February of this year. And what's really important to start watching for is, although we know some of the pass-through has been muted in apparel in particular because of so much front-running of tariffs, much of what you're buying from the shelves right now is actually pre-tariff in things like apparel. Other places it's starting to show up and seep into even our grocery store prices. Canned goods have gone up quite dramatically, along with anything non-alcoholic beverages. Also, those aluminum tariffs starting to show up there. That's something we saw the last time we had a trade war, but it's something we're watching very closely because there's no margins there, and there really is only one place to go, and that is for it to show up in consumer prices. On the other side of it, we're going to be getting PPI data later this week. We expect a little bit of an uptick there. 0.2% as well. And consumer spending, retail sales come out at the end of the week. They'll come out north of 1%, and that's because of strong spending, particularly on vehicle sales. A lot of consumers, we had another one of those record electric vehicle months. The idea that the tax credits were going to expire. People are buying ahead of that on electric vehicles, and that's going to show up as strong vehicle sales during the month. What we'll be watching really closely is a place tariffs have been high, and that is in building materials. There was a lot of stockpiling last month, and it'll be interesting to see what happens to building materials because construction activity has been weak, but also there's a lot of tools have seen increases in price by quite a bit because a lot of tools are actually imported as well. So that's an area we're going to be watching closely in the retail sales data as well.
Yeah, I mean, it could all hit at once, right, Diane? We could see that pop in inflation along with the material, weakening in the labour market. What would allow the Fed to cut in September? I mean, if we see very strong inflation data tomorrow in some of the sectors that you mentioned, would the Fed be comfortable cutting?
That's the unknown question, and really until we see an increase in the unemployment rate, the Fed is going to leave the September meeting live, and you see some people within the Fed moving towards that rate cut in September, others pushing back. It's still up for debate, and much will hinge on whether or not we see an uptick in the unemployment rate between now and then. And much of the bulk of the losses and the cuts due to things like federal layoffs and the spillover effects into local communities, that hits after October 1st. So it's not clear we'll see enough of a deterioration in the labor market in addition to the weakness we've already seen, which the Fed has sort of portrayed as, demand and supply has come down in sync in tandem with each other, which has held the unemployment rate unchanged. But I look at the labor market today as a lot like the housing market. Those who are in in are locked in place. They're not quitting. They're not shifting jobs. They're not getting that higher wage somewhere else because it's not that strong of a churn, a healthy churn in the labor market. Quit rates and hiring rates are well below the pace of 2019, along with layoff rates now moving up, and the long-term unemployed have moved up as a share of overall civilian labor force. That's usually a sign of recession. We don't think that's happening yet, but nothing is going by the old rules.
Well, given the current backdrop, at least the backdrop that we know right now in the labor market, what does that do to consumer psychology? We're going to get a retail sales report on the 15th, and I mean, we're expected to see a bit of a deceleration in that growth rate, but a lot of people are saying that once we get past the most recent month, we could see even further deceleration.
That's what we're worried about the most. And so, it's still ahead of us. We're still seeing people buy ahead of tariffs, and there are places you can still do that. We know that coffee prices have gone up a lot, but those aren't the ones from tariffs yet. That will hit later this year with the 50% tariff on Brazil, and coffee is one of the biggest importers, things that we import from Brazil. So coffee prices, which are already up at a double-digit rate from a year ago, something I know only too well. That's something I'm watching very closely. But I think it's very important that the labor market is weak. It is sort of that those who are in the labor market are stuck and those who are on the outside are unable to get in. And that's similar to that locked in, locked out, sort of what we're seeing in the housing market too. And that inactivity is the enemy of moving forward.
Yeah, absolutely, too. And it's not just coffee. I mean, we've seen beef prices as well go up, obviously, irrespective of the tariffs. I have to ask you a question, a touchy question, Diane, and this is really about the credibility of U.S. economic data going forward, given what happened with the BLS commissioner, whether it's fair or not. There are a lot of people that are going to look at these next few reports, economic reports out of the government, and there are going to be some conspiracy theorists. They're going to look at those numbers, whether they're good or bad, and question whether they're accurate. And I am curious as to how much faith you are putting into the accurate collection and dissemination and presentation of data in the months ahead.
Well, we already know on the CPI data, I think it's really important, is about 35% is being imputed right now because of budget cuts that we've seen. And I think that's really, people don't realize that the cuts have consequences, and they do. We've have certain offices that are no longer open where people used to go out and do actual comparable, do field work to be able to gather some of this data. Those people are no longer being paid, and there's a hiring freeze, and they're not being replaced either. So those are holes in the data that we just don't know because it's based on history. And the economy is changing so rapidly, that's very difficult to capture. And then you throw on top of it that you've had this sort of damage to the infrastructure of the system due to budget cuts that have been going on for years, I might say. Not only are the response rates lower on many of these statistics we see out there, but in general, we have seen, budget cuts that have eroded the ability to cover a lot of economic data. And so now you see the agencies cutting back to the bare necessities rather than what is nice to have, and a lot of data sets are being cut. That's something that I worry about going forward. And we have a lot of other data on the U.S. economy that we look at, but none of it has the transparency. I know people don't understand this, but the federal government is responsible to be transparent on how they collect the data, what's wrong with it. They told us about the CPI data, what they imputed, how that affects the data. That's a very important thing to have, and that's what we'll be looking for going forward and watching if there's any changes in all of that.
All right, Diane, always wonderful to talk to you. Diane Swonk, KPMG's chief economist there. And just a reminder, Team Surveillance will have full coverage of the release of that CPI report tomorrow, 8:30 a.m. Washington time. We get PPI on Thursday, and on a Friday, we round it out with retail sales, as well as a look at consumer sentiment numbers. Meanwhile, here in the after hours trade, some of the stocks that actually had big moves during the cash session, and it's kind of interesting to see what's actually been driving this market, Bonnie, because it's not necessarily the broad macro themes. Today, we were talking about lithium prices. We were talking about cocoa prices. I don't know what we were talking about with Fannie and Freddie. And then at the bottom, marijuana. which apparently the Trump has said maybe we could see some sort of clarification with regards to their regulatory status around the country. And you see the moves there on your screen.
Well, you do sort of want to shout at everybody, you know, to be careful and maybe to wait, because a lot of these moves happen immediately that Trump says something, but it could take months or even years for the actual impact to happen. So, you know, is he going to declassify marijuana or downplay marijuana as a drug immediately? No. Is Fannie and Freddie, are they going to have a share sale immediately? Well, maybe not this year even.
All right, well, you see some of the big movers here on the day. It'll be interesting to see whether those are the big movers tomorrow. A lot more coming up in the show, in the here and now, right here on The Close on Bloomberg. All eyes right now on the White House, where the CEO of Intel, Lipschultz, was said to be entering the White House to meet with President Trump. This just days after the president called for the CEO's resignation, citing some concerns about his previous job at Cadence Designs, as well as some concerns about his alleged ties to China. Jay Goldberg joins us right now, analyst at Seaport Research Partners. He covers the chip sector there. And Jay, I am curious here about what Lipschultz can actually accomplish, because, you know, when he was appointed CEO, I think it seemed like there was a big round of applause. The idea that you had somebody who knew the company, who knew the chip sector well, and was pretty widely respected. But now you have the political element being injected into this. And I do wonder if you worry that that could maybe bring his very short tenure to an end.
Well, it's a tough one, because Lippu is one of the most widely connected figures in Silicon Valley. I mean, I think he single-handedly held up the private capital pipeline of private semiconductor companies in this U.S. for 10 years. Like, he's done immense work for the industry. He knows everybody. And that's very important for what Intel wants to do commercially. They need to get customers to their foundry. But he's got a very, very tough job. And unfortunately, the board has left him in a position in which this is sort of their, I don't want to say Hail Mary, but it's certainly they have a very limited set of options available to them, and this is the hand he's been dealt. And so I think the board seems to have put themselves in a position where the only way they see out is to get government help. And in that situation, knowing everybody in Silicon Valley isn't as important as everybody in DC.
Yes.
And so, yeah, he's in a tough spot.
Well, it raises the question, though, if not Lipschultz, then who? I mean, it seemed like they already had trouble finding a good external candidate to begin with when they were looking to replace Gelsinger. If the Trump administration does force the board's hand, basically saying, hey, we're not going to help you out unless you get somebody in there, I mean, who are the candidates, Jay?
It's not a long list, because it's a very big company, so that's not a lot of CEOs. I know in their last search, they talked to a lot of people. I know some of them personally. Not many people are interested in this. This is a pretty challenging role. And so there is no obvious easy candidate the way there was, I think, for Lippu or for Pat. And so I don't know. It's a very good question. I don't think anyone has a clear answer to that. I will say that I think what matters most is that they should probably overhaul their board first. That's I think a big source of problems. I think that will greatly open up their solution landscape, is if the next incoming CEO has a freer hand. And I'm not even assuming that they're going to get a new CEO, so I don't want to presume that Lippu's out, but just I think the board has to change.
Sure, although four of them at least, have been on the board for less than a year, right? So I definitely want to ask you more about that in a moment. But first of all, it feels like it would be crossing a line for the president to actually force a company to get rid of its CEO, right? I mean, he's done a lot when it comes to forcing regulation or forcing companies to pony up money and so on, but actually messing with a company's structure, would it be crossing the Rubicon?
Well, I mean, I want to be careful weighing into political commentary, but I will say that I've spent a lot of time in China. I've gone there many times. I've lived there for a while. And, China has been moving the opposite direction. For the last 40 years, they've been freeing their companies from government control, and we seem to be wanting to go in the opposite direction. I don't think it's a great sign. It's not just this deal with Intel. We also have AMD and NVIDIA yesterday disclosing they're going to have to have to pay a tax to the U.S. government for their sales to China. So we're definitely in unprecedented territory here. I don't know what comes next. I'm watching this as intently as everyone else, but really hard to say.
Just real quickly, I am curious to your reaction, though, on that 15% number, which a lot of us, I think, were speculating on but had no idea. I mean, does that just basically mean that if you're selling a chip to China, you're basically paying 15% more on top of that? Or are these companies eating the costs?
I think that remains to be seen. I know that China gets a vote in this. Certainly, there's been a lot of scrutiny in the Chinese press over the last 2-3 days. NVIDIA has been called in to talk to the Cybersecurity Authority and other regulators in China. China has a vote on that as well, and so my best guess is that the companies will eat that, but then that's not good for U.S. shareholders or any shareholders.
Jay, we actually have to leave it there, but thank you so much, and we will be back on to you as soon as we know more about the Louboutin meeting with the president. That is Jay Goldberg, analyst at Seaport Research Partners. And speaking of chips in China, President Trump extending a tariff truce with China for another 90 days. The truce, which was due to expire tomorrow, will be prolonged in order to allow the world's two largest economies to continue negotiations. For more, let's go to Henrietta Treyz, Veda Partners Managing Partner and Director of Economic Policy. How much thought was put into this 90-day extension, Henrietta? Is it just that the president is quite busy right now, what with Vladimir Putin coming to Alaska and so on?
This 90-day pause had to happen. Back when the U.S. and China met in Stockholm and in London, the president overplayed his hands. He put on a 145% tariff that is way too high to continue trade, and China responded very flatly, upending the entire automobile manufacturing space and defense with their magnets and rare earths export restrictions. So the president of the United States was not in a position to continue hammering China, let alone escalating the tariff rates back to 80%, which would spike inflation. And now that all eyes are on inflation data coming out tomorrow, this is not an opportunity that the president can afford to have tariff rates spike on, $550 billion worth of goods coming in from China. So this had to occur, in my opinion. The president didn't have another play. He had to delay.
Where are we on negotiations with China? I mean, the president keeps teasing that there will be a meeting with, the Chinese premier at some point, but we're not really getting that many updates when it comes to, the rules of the road here when it comes to tariffs.
Yeah, the president's definitely hungry for a meeting. You could say that pretty clearly, or the kids would say he's thirsty for it. That's something that they're trying to get in October. We'll see if President Xi will actually engage in that meeting. They've been promising something along those lines since the beginning of this year. I think the most important thing for the president to telegraph right now is that the Chinese will start purchasing soy and agriculture exports again from the United States. As you know, in the last 6 months, China has stopped 50% of its purchases of agriculture, from $11.6 billion to $5.5 billion. So we're going to need a round of farmers bailouts, and they're going to need to pick up their ag sales. The president is talking about quadrupling it, which would effectively mean getting back to stasis and then hopefully adding another $5 billion on top of that. But the farmers need to be addressed immediately, and that's going to be anything that occurs in October would be around an agricultural component at this point.
Well, it'll be interesting to see if they can get to that. And it gets to this idea, Henrietta, of some of the challenges out there. And I do just want to go back to the NVIDIA, the news that we learned with regards to the 15% excise tax, if you will, on any chip sales to China. I mean, set aside the fact that the Constitution doesn't actually allow for that type of export tax. But it raises the question as to how much faith can we put into the idea that these levies, taxes, whatever you want to call them, these policies will even be around. So for investors sort of trying to make a decision as to what the impact will be, do you have any sense that maybe these legal challenges might remove some of that cloud if they're successful?
Romaine, this is the question of the second half of 2025. It's going to be, can this 15% tax on NVIDIA hold? Is it obviously not constitutional under the Article 1, Section 9? The IEEPA tariffs in and of themselves are likely to be found unconstitutional by the appeals court sometime in the next few weeks, maybe a month or so out. And then you have the question of, does he have to rebate and refund every single importer in the United States from whom we've collected $150 billion thus far this year? That's the outstanding question right now. And the president's entire trade agenda hinges on those questions of constitutionality. Already, the Court of International Trade found unanimously that the president does not have the authority to impose tariffs under IEEPA. I listened to the court case a week or so ago when the oral arguments were heard, and it was pretty clear that the Federal Circuit Court, the Court of Appeals, doesn't think that they have the bandwidth or the latitude constitutionally to do it. And the question then will become, What does the Supreme Court say? And we're taking this all the way to the top, I guess, is the takeaway.
Yeah, and if they rule against the administration on these issues, it could actually create a little bit more volatility and chaos out there. But there's also another question, Henrietta, about our trading partners. A lot have at least moved on, or at least are trying to move on. And I know it's impossible to completely decouple from the world's largest economy, but the idea that they're even thinking about altering that relationship on their end, that's not something, court case or not, that's just necessarily going to go back to where it was pre-administration.
I think Canada is the clearest example of that. They're going right around the United States and negotiating directly with Mexico right now. And you're seeing that internationally with China and Africa, with Southeast Asian nations and China, with the EU and other Southeast Asian nations. Everyone's response function has been sort of like a drop of oil in water. They've all dispersed and they're going elsewhere. And I think the Canada-Mexico example is the nearest and dearest to my heart, and obviously physically closest, but those are our biggest trading partners, and they can no longer have tariff-free trade with the United States. 35% tariffs on Canada escalated just on Friday over lumber, and there's still more Section 232 tariffs to come. So that's creating a whole new group of friends internationally for everyone else, but not for us.
Absolutely. All right, Henrietta, great stuff as always. Henrietta Treyz, Managing Partner and Director of Economic Policy over at Veda Partners, as we, of course, look for that 90-day trade truce extension between the U.S. and China. But, of course, a lot of ructions in between and a lot of court challenges that still have to be sorted out. We're going to set you up for what to watch over the next 24 hours when we come back after the break. This is Bloomberg. Not a whole lot of market catalysts on this Monday, but that could change in a big way on Tuesday. Several earnings set to cross the tape tomorrow, including from a couple interesting companies.
Yeah, we're getting Circle's first quarter, which, if you were in the IPO, you saw a 419% increase. We'll see if that continues. We also get, of course, CPI data in the morning. Yeah, we'll get CoreWeave, Kava as well, and on Semi. A nice read there on the corporate sector. On the economic front, that CPI report, 8:30 a.m. Eastern time. What are you expecting? Well, don't ask me about numbers. I'm just expecting that it could be a conundrum for the Fed. We're gonna get some Fed speak tomorrow as well, including from Barkin and Schmidt. Is there anything they can say? Well, yeah, I'm sure they'll find something to say. I'll tell you what else we're anticipating. The OPEC monthly oil report. Oil has been soft, of course, remain trading around $66 a barrel today. All right, we'll be back here tomorrow with all your market moving coverage. For all your political coverage, stick around. Balance of Power is up next, right here on Bloomberg. Thanks, guys.